welcome everyone. Thanks for joining us here today for our second session of the third quarter. We're going to be focused on using options as an efficient use of capital this quarter. Hope you enjoyed last week's session and looking ahead. August 14th, we'll be talking about the poor man's covered call, and August 21st, option strategies for higher volatility. That'll be an in-depth look on implied volatility, Vega, and some associated strategies. So be sure to sign up for those. We've got a few guest speakers lined up for both of those sessions in August. My name is Ed Modlow, the Director of Retail Education at the Options Industry Council, and today I will be focused on using options to lower at-risk capital. I have a lot of concepts to get through today in about a 50-minute session or so. Here is our disclaimer and a little bit about OIC. We provide free, unbiased education to the investing public. Our website is optionseducation.org, where we have plenty of written material along with podcasts, videos, and webinars. And the great folks at the Investor Services team. They are professionals there to answer your questions. Their email is options@theocc.com. Feel free to send any options-related question to those guys, and they'll do their best to help you out. Speaking of which, we do have a few members of that team live, standing by behind the scenes. Ken Keating and Bill Ryan are both waiting for your questions. So if you have anything that comes up throughout the presentation today, please send your questions through. Those guys will do their best to answer questions live. Anything they can't get to here today live, they will be responding to within the next day or two by email. So keep your eyes open for your emails there. And as always, please take our survey. We look at every single bit of response we get, all of the comments and suggestions we take very seriously, and that helps us shape our program moving forward. So please take the survey before you leave us here today. The backdrop of the industry, here are the options exchanges. This is where all the action takes place. The orders are routed to these exchanges, and the executions all occur here. Also, these exchanges play a major role in a number of other ways, risk management being one, listing stocks or listing options on particular stocks. They have criteria by which they do that, listing expirations and strike intervals. All these decisions are made at the exchange level. We will have a little bit of insight on that a little bit later on in the presentation today. Here's a look at options volume over the years as we continue to see a very strong growth in the industry. And for these webinar sessions, by the way, we're getting a very high number of new attendees for every single session we do, which is great to see. For those of you who are new, you haven't seen this slide before, you saw a great uptick in options volume at the turn of the century. There's a number of reasons for that. Certainly, electronic trading played a major role, but we also say do-it-yourself investing. When investors took over control of their own money and started to learn more about options, the resources that they had, including OIC and others, by which they could learn about options, that played a major role as well. So we saw a major spike there. 2011, you see a peak, just under 5 billion contracts in 2011. That was the year of the European sovereign debt crisis, which raised volatility throughout the year. The years subsequent to that were very revealing and I think very strong for the industry, as volatility was low and the VIX index was below its long-term average. The options volume maintained steady, and we held strong above 4 billion contracts until 2018, where there was also some elevated volatility in the markets, and we cracked through 5 billion contracts for the first time ever. So presentation outline for today, we're going to start with a little bit on speculation and leverage at the crux of the presentation today. That's what we're going to talk about. And we'll move into choosing strikes and expiration dates. That's always a hot topic and a common question that comes across our desk. That section will also allow me to provide a little bit of insight into the Greeks. We'll touch on Delta and Theta a bit. And then we'll finish up with buying calls and puts all along the way. A lot of material for just about everybody, plenty of basic material, but each of these topics and sections provide the opportunity to give some insight for the more intermediate or advanced traders as well. It's probably a good place to start today, looking at what speculate means from a high-level perspective and a definition point of view. In common language, just speaking about speculating in general, that usually means someone has an opinion or a guess. That would be a synonym that people might use, speculating or guessing without really having evidence or without really having anything to back up why they're speculating. Or you might hear the phrase wild speculation. No basis or foundation for why they have a particular opinion on why something might happen. It's a bit different in the investing world. If you're going to speculate in stock trading, or here today options trading, you have an opinion, but you do have a foundation of analysis that you've performed prior to getting to that opinion. So there is something involved here a little bit more deeply than you might otherwise think when you hear the word speculate. You are hoping for gain. You understand there's the risk of loss, but you do have a method to why you have the opinion that you do. I'm always a little bit hesitant to compare investing to gambling because they're not the same, but there's no question that there are some similarities between the two. If you're gambling, for example, at the blackjack table and you're throwing money down on the table hoping that you win, well, you're betting something, you're hoping it turns out in your favor and you can get a gain, and you know exactly what you stand to lose or what your risk is. I don't really think that translates cleanly to the investing world, but more appropriate might be a card counting group. And this is the example that I use. If you're at the table counting cards, then you're performing an analysis on the situation, and you form an opinion and speculate on what's going to happen next, trying to give yourself an advantage or an edge. If you're able to do that and give yourself a better chance of being successful than failing, then you can make money over the long haul. And that's why card counting can be successful. And this comparison is a little bit close to home for me. I started in the business in 1997 working for Blair Hull's trading company in Chicago, Illinois, in the trading pits at the exchanges out there. Some of you may know that name. Blair is a legend in the industry, one of the most recognized names in the options industry. Prior to becoming a market maker, Blair was on a card counting team in Las Vegas, and that's what he did for a living, was bounced around to different casinos, counting cards, and making money that way. He did that until he got banned from those casinos because it worked. They gave themselves an advantage. That's when they bet. He was banned, and sometime later discovered options and went to the trading floor, and the rest of his career is history from there. But the bottom line is they're not exactly the same, but there are undeniable similarities between investing and gambling. The key takeaway here is when you speculate with investing and with stocks or options, there's a foundation for your opinion and an analysis that you start with. And as we focus on options today, that's where we're going to go. You start with a forecast that leads you to an opinion on several questions, starting with, are the shares going to go up, down, or stay the same? And then what is the magnitude of that direction going to be? You have to answer these two questions with some level of confidence. And that's a word you're going to hear me repeat over and over today in various segments and from various angles, is the word confidence. Because as you form your opinion, execute your trade, and then manage it, your confidence level is going to drive you to the decisions that you make. So we start with a forecast. What direction are we headed? What is the magnitude of that direction? And since we're involved in the options space, we also have to have a sense of time. How long is it going to take for that particular move to occur? Once we answer these questions, we can form an opinion. We have a grasp on what we'd like to accomplish, and we have a confidence level. Then we can decide on a strategy. And I'll say right up front, when it comes to speculating and buying calls or buying puts, those would be if your confidence level is very high. With the answers to those three questions, direction, magnitude, and timing, if your confidence is very high, it would lead you to consider buying calls or buying puts outright. If your confidence level is lower, you might look for something else that has reduced risk, mitigate your exposure through a spread of some kind, or change the risk profile to give you a better likelihood of success, giving up some potential gains. You might do some different things. But right away, with confidence level high, buying puts, buying calls, depending on your direction, is a viable choice to consider. With any strategy, with any position we have, we'd like to have an exit strategy, or at least some forecast of how we're going to get out of this position. And one thing to keep in mind is that options are usually closed before expiration. One of the myths that exists in this industry is that most options expire worthless. And investors might have heard that 70 or 80% of all options expire worthless, so why would I ever buy any of those options? Well, that is a myth that isn't true. The fact is, most options that are opened are closed before they ever reach expiration. In fact, OCC statistics show about 70% of all opened options positions never make it until expiration date. Of those that do reach expiration date, about 3/4 of those do expire worthless. And that's where the myth comes from. The myth ignores all of the closing transactions and only focuses on options that are held through expiration, of which the vast majority expire worthless. And that makes sense. If you own an option, you own an asset. And it's very likely that you will try to sell that prior to expiration for whatever amount you can get for it. Well, if it's not worth anything and you can't sell it, you have no choice but to hold it through expiration. So there's logic behind it, and the myth that most options expire worthless just simply isn't true. So we've set the stage with our forecast. We know what direction we think the stock's headed, how far it might go, how long it might take, and it's going to lead us to possibly buying calls and puts if our confidence level is high. What we want to do now is highlight the impact of leverage, and doing that through an example. Lower initial investment can result in higher percentage returns versus buying shares outright. The concept of using options is at least in part decided upon because of the lower entry cost. We're not buying shares, we're buying an option which provides us the right to purchase those shares, a far lower initial investment. Along with that, much greater percentage returns on both sides, both the positive and the negative, which we're going to see through this example. And I'll read through it to set the table. Due to recent events, Lindsay is extremely bullish on various pharmaceutical stocks. To speculate on the industry as a whole, she's found an ETF that groups several of these companies together. With the stock currently trading at $50, she can buy 100 shares and invest $5,000, or buy a 6-month 50-strike call for $4.50. Now, right here, I want to back up into Options 101 for those of you who are newer to options. First of all, rights and obligations. There's two types of options. There's calls and there's puts, and you can buy or sell either one of them. That leaves us with 4 outright possible positions. Buying a call option provides Lindsay the right to purchase shares of stock at $50 a share. As the share price moves up, hypothetically to 55, 60, or 70, the right to buy shares at 50 gets more valuable. It's more attractive. The strike price of 50 is fixed. Of course, the stock price isn't. So buying a call option is consistent with her extremely bullish perspective on the underlying share price. Also, 450. I want to point out that options are quoted and traded on a per share basis. Each option that Lindsay buys gives her the right to buy 100 shares of stock. $4.50 is on a per share basis, which means the aggregate dollar amount cost of this contract is $450. Stock's at 50, we buy the 50 calls for $4.50. We'll get into strike price selection in a few slides. Here we want to look at leverage and what it means. So let's start at the 50 line and just look across. If we own shares of stock at 50, we have no P&L. We have no gain, no loss, and the trade keeps moving. At expiration, I want to emphasize this is at expiration. If the stock hasn't moved, then we lost our entire investment in the options contract. The right to buy shares at 50 with the stock at 50 doesn't have any value to it. It's not worth anything. So we lose $450 or 100% of the investment. You can see right here, right away, how those percentage gains and losses are much bigger in the options space. If the stock moves higher, let's say up to 60, our stock transaction profits $1,000 or 20% of our initial investment. The options contract has gone up in value. The strike price is 50, the stock is at 60. That's $10 of value or $1,000 worth of value there. Lindsay paid $450 for the option up front. That leaves a profit of $550, less dollar amount, but much greater percentage return. And this is the impact of leverage, which also is true on the downside. Now that I look at this, the percentage gain and loss on the stock at the 40 and 45 line should be reversed. My apologies for that. That's a loss of 20% at the 40 line and a loss of 10% at the 45 line. The concept is still true. While more money is lost on the stock side, it's a far less percentage loss than you would see on the option side. The other key difference that goes without saying but worth pointing out, for trading stock, you don't have an expiration date. If it moves against you, you can hold the position. Options expire. And if our intention is to avoid buying shares, which is why we got into options in the first place, you have to be aware of expiration date. At some point, the trade is over and you run out of time to have the stock turn around and move in your favor without making a subsequent trade. We certainly could see the option expire with the stock down at 40 and then buy another options contract. We'd have to get back into the trade and spend more money if we thought the stock was going to bounce. Now, this was an example of buying one option against 100 shares or comparing the two. There's a more aggressive way to look at this and to showcase the same idea. If Lindsay was comfortable spending $5,000 and was choosing between buying shares for $5,000 or spending all of that money on options contracts, she could purchase 11 options contracts for just about that same amount. And you can see a similar effect here. The 50 line, no profit or loss on the stock. You lost everything on the options contract. That's a 100% loss. And as you move higher, with these 11 contracts, not only is the percentage gain much greater, but the dollar amount is much greater. And this is the impact of leverage. Again, keeping in mind the percentage loss, 10 and 20 are in the wrong spots. You have to flip those around if you're looking at those, but the dollar amounts are much, much greater if you want to lever up and spend the same amount of capital. So this is the idea that leverage is a double-edged sword. You can make great returns and you can lose in big numbers as well. So the options industry is just works that way. That's the way leverage works, and that's what you'll see if you're trading options outright. If those of you who have seen advertisements, maybe on social media or such, from individuals who claim to be world-recognized top traders or expert traders who ask for subscriptions, oftentimes they will use examples of trades that they've done in options, and they'll showcase 100% or 300% or 500% gains that they've been able to achieve in certain trades. And it's certainly possible to get that. In the options space, you can see that. If the premium goes from $1 to $3, you've made 300%. Those percent returns can be huge. But the real question is, how many times did they lose 70 or 80% or 100% for each time they made that big gain? To be straightforward, it's not easy to speculate buy options and be profitable. Remember those three questions at the beginning: the direction, the magnitude, and the timing. You really do have to be correct on all of those to be profitable this way. Don't want to scare anybody away from buying options. There certainly is a time and a place, but it is when confidence levels are high and you want to really capitalize on an opinion that you have, that you feel very strongly about. So now I promised some strike selection and expiration selection discussion, and that's where we'll get to here. First, I'll recap what in, at, and out of the money is. My definition is if the holder or the purchaser of an option has the right to execute a stock transaction at a more favorable price than is being offered in the open market, then that would be known as an in-the-money option. If the holder of a contract has the right to execute a transaction at a worse price than the open market is offering, that is an out-of-the-money contract. Pricing has two pieces. Intrinsic value is the difference between the strike and the share price, and that only applies to in-the-money options, while extrinsic value or time value is comprised of a number of things, of variables, including how many days are left till expiration, the implied volatility in the open market, dividends, and interest rates. With respect to these two, intrinsic value is very straightforward. If you own a particular asset, or if a particular asset is worth $50 and you are offered the right to buy that asset at $40, then that contract inherently has $10 of value in it. You're being offered to purchase that product $10 below its current value. You would expect to at least pay $10. In fact, you'd likely expect to pay more than that because of the possibility of that value going up. So intrinsic value is straightforward, difference between strike and share price for in-the-money options. Extrinsic value is more complicated. Implied volatility is the unknown factor that you see there. Everybody knows how many days there are left until expiration. Dividends are known. Interest rates are known. But implied volatility is not. And it changes all the time. I reflect on my days on the trading floor. When I got into this business, we were constantly changing implied volatility rates as supply and demand shifted. When we noticed bids and offers coming into the market through the order flow we saw on the trading floor, we adjusted implied volatility levels. I'll also say these levels are different at every single strike price. Put options, out-of-the-money put options, have higher implied volatility levels than out-of-the-money call options do, and that's because there's more demand. It's simply a function of supply and demand. Because money managers are more interested in protecting downside risk, they are more likely to be buying those put options to protect their portfolios, and that's why the demand is there and those implied volatility levels are higher. That is the great unknown with pricing. This is a nice recap slide of call options and put options. Again, using my numbers, if the stock is at 50 and the strike price is 40, the holder owns the right to buy shares at a better price than the stock is currently trading. That's an in-the-money option. For an out-of-the-money call, the strike is 60 and the stock's at 50. The holder owns the right to purchase shares at a worse price than is available in the open market, and that's out of the money. Puts are going to be the exact opposite. With the strike at 40, stock at 50, then you would expect the put option holder to pay very little. They own the right to sell shares at a worse price or lower price than where the stock currently is. That would be an out-of-the-money put option. If we had a strike price of 40 and the stock price was 50, then you would expect implied volatility levels to be higher at those areas on the put curve, on the volatility skew. But again, that's out of the money versus in the money. Very important to make sure you realize that moneyness does not equal profit. Moneyness just quantifies or clarifies where the strike price is versus the stock price. Profit is more simply what is the difference between what you paid for an option and what you sold it for. You can make that calculation very simply. It's basic arithmetic, but moneyness and profit really have nothing to do with each other than conceptually. If you buy an out-of-the-money option, You want it to become at the money or in the money. That means the stock price is moving in your favor and the moneyness of the option is changing in a positive way for your account. But beyond that, from a monetary perspective, those two concepts of moneyness and profit do not equal each other. Moneyness is used to determine intrinsic value. If the option is in the money, how much is it in the money? That calculation will give you the in the money amount or the intrinsic value. This is the price component that is sensitive to stock price movements. As the stock moves, the intrinsic value will change. If it's at the money or out of the money, it's zero, but if it's in the money by a certain amount, as the stock moves up or down, that in the money amount will change. So intrinsic value is sensitive to stock price movements. At the money and out of the money options are sensitive to stock price movements only if they become in the money. Otherwise, they're sensitive to changes in days to expiration or implied volatility rates or changes to dividends and interest rates. All those outside forces will be influencing at the money and out of the money options. Sticking with strike selection for a little bit longer, in the money strikes will naturally be more expensive. They have both intrinsic value and time value. So it makes sense that they are going to be more expensive. They're also going to have more favorable break-even points and the greater likelihood of having intrinsic value. They already have intrinsic value. So their break-even points are more favorable, and the sensitivity they have to stock price movements is going to be greater. They're more expensive. That's the downside. On the plus side, you have a better break-even point, and as the stock moves, you're going to see greater fluctuations in the option price. If the stock moves in your favor, you'll see that option price in dollar amounts start to move in greater frequency as compared to out of the money options. Eventually, if the stock moves far enough, your in the money option will begin moving one for one, step for step with the stock itself. For each dollar up, your option will move $1 itself. Out of the money options are going to be less expensive. They only have extrinsic value. You will need a greater move in the stock price in order to reach your break-even points and or profitability. And there's less likelihood, of course, that they will have intrinsic value at expiration. There's a trade-off here. As we're looking to decide what strike do we want to buy, there's a trade-off between these different levels of moneyness. Generally speaking, out of the money options are used for the investor who wants to be more aggressive, coming back to the concept of confidence. If you are more confident in your market outlook that the stock is going to move higher, then you would be inclined to buy a higher strike price option because your return would be much greater. Capital expense lower, cheaper option. If it moves in the money, the return will be much greater. So to distinguish between these two, the in the money strikes will cost more, but they will be more conservative in nature. So you're going to be sliding that scale again on your confidence level. We've already done it when we selected the strategy. Buying calls and buying puts is going to follow a confident outlook in the stock movement. Taking it from there into trade construction, you can do that again. Use your level of confidence to decide what strike do I want. The more out of the money you go, that equates to a higher level of confidence in your market outlook. I want to look at what a chain might present to you, and then we'll get into Delta a bit. First, with the stock here at $75 a share, 45 days till expiration, and 30% implied volatility. Let's look at the at-the-money line. The call value that you notice on your chain is $3.15. The delta we'll get to in a second, and break-even point. That's something you likely won't see on your options chain, but you can calculate it very simply. If we pay $3.15 for the 75 call, we need to get $3.15 back. By expiration, that option needs to be in the money by that amount. If the stock price is at $78.15, then we've paid ourselves back the $3.15 and we can profit with the stock above that level. I'll just define delta a few different ways. Delta is the expected change in the options price for a $1 move in the stock. In the case of the 75 strike, 52 cents tells us that the stock moves up $1. We would expect the call to move up by 52 cents. If the stock moves down by $1, we would expect the call price to move down by 52 cents. I have to point out, delta is dynamic. It constantly changes. It is not static. And it assumes all else remains equal. So while we can use delta to forecast estimated values into the future, it certainly would be expected that if the stock did move $1, the option price would not change by exactly 52 cents. There's going to be some slippage there just because of the dynamic features of the Greeks themselves. On the put side, I'm going to flip this analysis around. If the put delta is 48, then we would expect if the stock moves up $1, the price of the put moves down by 48 cents. It's the opposite from the calls. If the stock moves down $1, that's in favor of the puts. Remember, the owner of a put option has the right to sell shares. If the stock moves down, that gets more valuable. Question is how much more valuable? And delta is estimating that that would be 48 cents. Another definition of delta, which is loosely understood, is that it represents the percentage likelihood that an option will finish in the money. Look at the 65 line, the calls with a 92 delta. Now this is not mathematically exact, but it is understood. In fact, I was taught when I started in the industry with Blair Hull and his team that it is a reasonable interpretation that the delta represents the likelihood that the option will finish in the money. And you see on the downside, the 85 strike has a 13 delta, or estimating 13% chance of finishing in the money. You can use that analysis to also help fine-tune your strike selection. Our confidence is going to help us determine where that strike is, but we can also look at delta. That's what the market is telling us. Without any directional bias whatsoever, what does the options market imply to us as far as the likelihood that this option will finish in the money? And you can use that to help you decide a bit on strikes as well. So there's quite a bit there on confidence and using delta to help shape your strike selection, also realizing the moneyness, in the money, out of the money, and the trade-offs between those for strike selection. Now, what about expiration and selecting your expiration month? First thing I want to say is most of the widely traded names with high volumes have weeklies, monthlies, and leaps, but not all options do. Back in the day when the industry started listing options in the early 1970s, there were only monthly contracts. As the industry has grown and evolved, the exchanges have continually tried to list more and more options for trading to facilitate customer demand. Exchanges want as much trading as they can possibly get. That's how they make their money. So they want to list what the investor is interested in, but they don't want to go overboard either. Currently today, we are approaching almost 1 million unique options series that are tradable. That's a burden. Technologically, that's a burden, but that's also something on the market makers. You have to have a market maker putting up bids and offers on all of those series. So the exchanges don't take that decision lightly. Monthlies will exist if the stock trades options. Weeklies and leaps will be added if the volume is there and the exchanges believe that trading will occur if they list those. So those are your different choices, but again, the most widely recognized names have weeklies, monthlies, and leaps. It's important to understand that time is money. Of course, a longer dated option is going to cost more than a monthly or a weekly will. We come back to our forecast. Hopefully, we were able to determine or come to a reasonable conclusion on how long do we think it'll take this particular market move to occur. And that can help lead us to an expiration date. But regardless of that, whether we have that or not, we do need to be aware of theta and time decay. And this is a graph showing the rate of time decay over time as we approach expiration. For in-the-money options, for deep in-the-money options specifically, the time decay is linear. There's very little extrinsic value or time value. I use those words interchangeably. Extrinsic and time, they both mean the same thing. You'll hear that a lot, so hopefully that doesn't confuse anybody. For in-the-money, especially deep in-the-money options, there's very little time value, and so that decay is linear as the option approaches parity. Some of you might be familiar with that term. If you're not, don't worry about that for now. Let's focus on the at-the-money curve. For at-the-money options, which have the most time value, where theta is the greatest, time decay is very slow in the beginning. With a year or 9 months, time is the decay of the option, or the rate of decay, is fairly slow. It's generally recognized right where that arrow is that the increase in the rate of decay begins around 40 to 45 days until expiration. And then it continues to increase all the way through expiration. The fastest rate of decay that you will recognize is going to be on options expiration day itself. However, premiums also get smaller. So when you're buying options, there's a trade-off between the two. Now I can say pretty bluntly that at-the-money options with 40 to 45 days is right where that decay starts to accelerate, and that might be the least attractive point to buy options. If you go longer dated than that, the advantage you gain is slower decay. That's a tremendous advantage. However, you do have the possibility that you're tying up capital for a longer period of time, and the option itself will have less sensitivity to the stock price movements. It's not going to move as closely to the stock as the near-term option will. And of course, the long-term option just simply costs more. So you have all those mixtures of pieces. Great benefit is slow time decay for the long-term option, but it's a higher price, and it's a bit less sensitive to the stock price itself. The opposite is true, of course, for the near-term options. They will cost a lot less. The premium amount is much smaller. If the option moves in the money or with big stock price movements, the near-term options are going to see the greatest effect and the biggest percentage returns. However, the time decay is very fast. So there's positives and negatives either way. From one trade to the next, you might decide to go long-term or short-term, depending on your confidence level and what your risk tolerance is. Let's just take a look at numbers to showcase this idea with the stock at $50 a share. And we're looking at on the left side, implied volatility levels at 20%. You can see with days to expiration at 365 what the theta is, and then all the way down to 5 days until expiration. On the right side, we've doubled the implied volatility level to 40, and that just magnifies the effect. It virtually doubles the price of everything, and you can see from 365, just focus on the top for a second, 365 to 150, and that's just over 1 penny, and 200 or so days later, the theta amount is 1.7 cents. Just look at that difference between those two, and then look at the bottom of the screen, 10 days to 5 days. We go from 6.7 cents to 9.3 cents. And you can just see how that magnitude, the difference between those, really begins to accelerate when you hit that 40 to 50 day mark all the way through expiration date. This decision on expiration date is largely going to come from your confidence level. If your forecast is driving you to a particular expiration date, maybe you want to give yourself a little more time just to give yourself the opportunity to capitalize on a move and not have your option expire before it happens. You can choose that longer term expiration date. Short term, if you go that route, you got to be right. And there's a time and a place for it. But if your direction is right, your magnitude, and it does happen right away, you can get some good returns off of short-term options. Of course, you're risking more. The risk of losing your entire investment or most of it is certainly going to be greater if you use the short-term option. So now we've covered some basics, strike selection, and talked about theta. We do want to get to our examples. Buying calls is the first one we're going to start with. Of course, we're going to be bearish or bullish to start with. That's our forecast in the underlying stock. We think it's going higher, and we're not interested in spending all the money that it would take to buy shares of stock. So instead, we look to the options market for a lower investment, a lower cash outlay, and knowing exactly how much we can lose. That would be 100% of our investment. Whatever we paid for it is the most we can lose. The value of the option cannot go any lower than 0, so that's the most we could possibly lose. In doing this trade, we've now levered ourselves into the position, and we understand that the percentage gains and the percentage losses will likely be big numbers. So here's our example. Stock is trading at $60 a share. Of course, we know if we buy 100 shares, that would cost $6,000. We're bullish. We want the limited downside risk. And we buy the 3-month 60 strike call at $3. We're going 3 months out. We're going on the long-term side. We don't mind paying a little bit more. It's about 90 days out. We're away from the quick time decay or the accelerated theta decay. We've moved beyond that out 3 months and at a reasonable confidence level. If we were more confident in our outlook, we may go up and strike. Less confident, we might move down. Here, reasonable confidence level, we pick the at-the-money strike of 60 and pay $300 for it. It's very useful to look at what will happen at expiration at various stock price levels, just so you can get an idea of what the risk profile looks like. And you can see at $60 a share, our call option doesn't have any value. It's not worth anything to own the right to pay $60 when that's what the open market is providing. So we lose our $300 investment on the way down as the stock moves lower and lower. That's the most we can lose. The worst it can get is $300, but remember, that's 100% of our investment. On the way up, that fixed cost of $300 is going to be there, but we will now can start to participate in the upward movement in the stock. If you look at this, and we're going to put it up in a second, where do we break even? Remember, we paid $3 a share, $3 for the option, so we have to pay ourselves back. At expiration, the 60 strike needs to be $3 in the money for us to break even. And let's put that up on a profit and loss graph. You'll see that here. There's our break-even point, 63, as compared to where the long stock is. If you buy shares, you're spending a lot more money, but your break-even point is clean. It's at $60. If you buy the option, the capital outlay is a lot less. You have upside participation, but you do need to see a move higher in the stock before you reach your break-even point. Just want to clarify again, this is at expiration. So $63 looks like a decent-sized movement. It's about 5% move in the stock that you would need to see. But most often, as I said earlier with the statistics, most often investors are buying calls or buying puts with the intention of selling them before expiration. So if the stock moves up to 61 or 62 or 63 very quickly and very soon, we may have an opportunity to track the price of this option and close it out for a profit, even if it never gets to 63. If it goes to 62 within a day or two, it's a very good chance that the option price is going to be greater than $3. I do want to clarify something. The reason or circumstance where you need to be careful is if you are buying calls and speculating prior to an announcement, such as an earnings announcement. If this situation was right before earnings and the announcement came out and it was somewhat positive and the stock jumped from 60 to 62 in one day, we might not notice the option value go up all that much. And you have to understand that volatility plays such a crucial role in the options market. If an earnings release has been completed and it's just finished, then the uncertainty of future news or movements is now greatly diminished. The implied volatility levels prior to the announcement are going to be much greater than after the announcement. And this could lead to a situation where you buy a call option, you see the stock move in your favor, but the option doesn't gain value or gains very little or maybe even loses a little value. And that's because of the conflicting forces of the Greeks. The option responded in a positive way to the stock move, or I should say, the stock moving higher had a positive influence on the option price, but the other forces, notably implied volatility, might be working in the opposite direction. And after an earnings release, that is generally the case, that implied volatility levels move lower, and that works against the option holder. So you have to be aware of that as well. It's also very useful to try and predict, since we're not anticipating holding this all the way through expiration. You might ask yourself, what might this option be worth in 2 weeks if the stock goes from 60 to 62? And you can predict that. You can use calculators. At our website, we do have a tool, an OIC calculator, where you can input your own parameters, and you can change these details and input a stock at $62 a share and input the option that you own along with changing the days to expiration, and then implementing different implied volatility levels to see what might this option be worth 2 weeks from now if the stock has moved with less days to expiration at different potential implied volatility levels. And you can try to forecast what the option might be worth. That can help you determine what price you might want to exit the trade at. Of course, you're going to try to exit for a profit, but as you forecast out 2 weeks, are you looking for $4 on the option, or $4.50, or $5? A calculator can help you forecast where that might be and help you make that determination on where you want to exit. And there's our max loss. As we know, the most we can possibly lose is $300. That's what we put up for the trade, and that is a big benefit of using options versus stock. You give up some of that break-even point at expiration, but lower cost of entry certainly plays a big role. Now let's shift, and we're going to look at things from the opposite direction, from the put side. Why buy puts? Well, here we are bearish on the stock, and we're looking for a way to capitalize on the stock moving lower by spending a little bit amount of cash and an alternative to selling short. Now, it's very likely that most listeners, most investors are not selling short on a regular basis, if at all. For those of you new, selling short just means you are borrowing shares. You're not buying them, you're borrowing them, selling those shares in the open market, and then you purchase them back later and return the shares you borrowed. You're selling first, hoping the stock drops, and then buying the shares back at a later time, hopefully lower for a profit. That's just a process that most investors are not doing. So if you have a market opinion that is bearish and you think the stock is going to drop and you're just trading stock, you might be left with no decision other than do nothing because you're not going to sell short. The options market gives you an opportunity to capitalize on this by buying puts. If you own a put, you have the right to sell shares of stock at the strike price of the option. As the stock price moves lower, the right to sell at that price becomes more attractive and more valuable. A little bit on options terminology. When you buy an options contract, whether it's a call or a put, you are the holder or you are long the contract. Don't get that term confused with market outlook. It's much more common to hear the word long as a directional opinion. If you're long the market, you think it's going up, and if you're short the market, you think it's going down. That's on the stock side or on the market analysis side. In the options space, if you are long a contract, that means you bought it, whether it's a call or a put. It has nothing to do with market direction. If you've sold a contract, you've shorted the contract. You have an open short position. Again, doesn't mean bearish, just means you've sold it. In this case, we are long the put option with a bearish outlook. So just make sure you have that terminology straight. And let's get on into our example for put buying stock XYZ, trading at $36 a share. Investor is bearish on the stock, wants limited upside risk. That means as the stock moves higher, we don't want to lose too much, and we go into the option space. We buy the 35 strike put, a little more aggressive than going at the money. We think the stock really is going to move lower, so we just go slightly out of the money. That's going to reduce our cost and potentially increase our returns if we're right. And here is the P&L graph. Let's focus on the 32.75 stock price at expiration. That's our break-even point. We paid 2.25 for the 35 strike. We need to pay ourselves back 2.25 at expiration to break even. That will happen if the option is 2.25 in the money, and we'll get to that point with the stock price at 32.75. That's our break-even point. And again, that's only if we hold through expiration. Prior to expiration, we're tracking the option price of 225 and looking for a place or the appropriate time to sell the position and close it. If this does take a while to come to fruition and the stock really isn't moving and you do end up holding it through expiration, it's a little bit more important on the put side. Of course, it's still important on the call side to understand what happens at expiration. For example, if the stock closes on expiration at $34 a share and you still own the option, that option has $1 of value in it. You'll clearly see you're not at your break-even point yet. You've lost money still, but you have $1 of value that you need to extract. You have to do a proactive closing transaction to at least mitigate your loss and get that $1 back. If you fail to do that, then you're leaving money on the table and potentially may end up with a position you don't want. If you had the 35 puts and the stock closed at 34 on expiration day and you failed to do anything at all, well, the industry has to know what to do with your contract. You own it. You haven't sold out of it. You haven't told your brokerage firm anything. The industry has a default process. It's known as exercise by exception. If the option is 1 penny or more in the money at expiration and you have taken no action whatsoever, then the industry will exercise that contract on your behalf. In this case, that could be a little bit risky because you'd be selling shares of stock. You might not be allowed to do that. Your brokerage firm may not allow that to happen, and you might not want a short stock position, which could come back to bite you on the next trading day. So be aware of that. If the option is in the money, but it hasn't reached your break-even point, you still have value that you would want to extract out of it. And then to emphasize my later point about expiration and exercise by exception, even if the contract is trading right around 35, it's trading within pennies, maybe 34.95, 34.98, and you just can't sell it. No one's buying it, there's no bids, and you can't do anything with it. If you don't want that option exercised, it's very important to proactively communicate with your brokerage firm and let them know that you do not want to exercise this option that prevents you from having a position the next day that you didn't want. You own the option. You have the right to do anything you want with it, but if you take no action, then that default process may apply and you might be subject to a transaction in shares. We can take all those numbers and then put up our profit and loss graph. Again, that dashed line is short stock. It's very likely for most of you that's not a choice. That's not a trade you're willing to make or would be even allowed to make. So to capitalize on the downside, options might be it. The only way you can try to capitalize on the bearish move is to buy a put, in this case strike price 35, and then you can look at this, knowing that at expiration you know where the stock needs to be to break even, and prior to expiration you can track the movements. If the stock moves down to 35 or 34, we can start to look at the premium. It's at 2.25. If it moves up to $3, 3.25, 3.5, we could sell out or start to scale out of our positions. And that's put buying. We've done this a few times today, putting this together into a summary slide. Call buyers and put buyers, you have rights and obligations. Certainly when you're buying options, you only have rights on the call side, the right to buy shares at your discretion. For the put buyers, the right to sell shares at your discretion. If you're speculating, it's likely that you are not dealing with shares and exercising, but instead you're looking to sell the option prior to expiration for a profit. We've walked through the market outlook, bullish for calls and bearish for puts. And then benefits, rising prices for calls, small cash outlay, and it's possible to buy shares below market price. If the stock moves greatly higher and you've changed your opinion and now all of a sudden you're comfortable buying shares and spending all that money, you could go ahead and do so. On the put side, again, a lot less likely that you're going to go ahead and sell short the shares, but you can take advantage of falling prices with a relatively small cash outlay and risks. 100% of premium paid, that is the most we can lose. Things to remember, option buyers will have the ability to speculate on a directional move. The premium paid is the most you can possibly lose. Strike selection can be the result of a variety of factors along with the expiration date. I'm going to repeat that word of confidence in a variety of ways. The confidence you have in your forecast, the magnitude of the move, how long it's going to take to get there, that could lead you to your strategy decision of buying calls and puts if the confidence levels are high. Again, sticking with confidence, strike selection. Out of the money options, and the further out of the money you go, are more aggressive and consistent with more highly confident outlooks. In the money options, a little more conservative, higher cost, but better break-even points. So confidence plays a big role in selecting the strategy and the construction of the trade itself. Time is money. Remember Theta. Remember where that tipping point is on the rate of decay, around 6 weeks or so till expiration. You could avoid that time frame going longer or shorter and understand the differences between the two. When you go longer in time, you're paying more. The sensitivity to the stock price is less, but the rate of decay is also very less. Those are the trade-offs. Short-term options cost very little. Their sensitivity is greater. Those are good things, but the rate of decay is its fastest. That works against you. Trade-offs between those two and the passage of time. Because we're buyers, the passage of time is definitely going to work against us. So hopefully that covered quite a bit with respect to buying options, how you do the analysis, how you construct a trade, and some of the more fine-tuning points of getting strikes and expiration dates. These strategies, of course, with many others, we do have on our website. We have podcasts, videos, webinars, and live help from the industry professionals at Investor Services. Those guys can be reached at options@theocc.com. You see our website domain up top and our social medias. I want to remind everyone, please take the survey before you head out for today, but also check out our YouTube channel. Plenty of webinars are available there, our Facebook and Twitter as well. So we are out of time for today, folks. I hope you enjoyed the presentation as much as I enjoyed giving it to you. Again, please reach out to Investor Services with your options-related questions, and we will see you next time, August 14th, for our next webinar presentation. Thanks for joining us today, folks. Have a good day.